Should we invest in the stock market or the property market? This is not a simple question, but in this video we'll consider the pros and cons of both types of investment, and we'll look at the historic returns to see which has performed best in the past. But we'll also look at the risk of those investments. Remember, if you do enjoy our content, please do subscribe to our channel and like the video. What kind of property are we talking about? Well, here I'm going to focus on residential property. We're talking about buy-to-let property in the UK. It's not commercial property and it's not the home you live in. That's very different. This is about property as an investment. So what we're going to do now is run through the pros and cons of each of those types of investment, starting off with stocks. So what are the pros of the stock market? There's loads of data on how well stocks have performed, going back for a century or longer in some cases. And what's really clear is that if you stick with this market, keep diversified, and don't sell in a crash, for example, then you generate very good long-term returns. What kind of returns are we talking about? Well, inflation plus 5% is roughly the long-term average. There are various sources of this information, but one which I use a lot is the Dymson-Marsh-Staunton data, and this comes from the Global Returns Yearbook, which they publish every year. It used to be the Credit Suisse Global Returns Yearbook. Now it's the UBS Global Returns Yearbook. So, if you want an investment that is going to beat inflation long term, and of course, we all do, then stocks are a pretty good way of doing that. Also, in the UK and elsewhere, there's very generous tax-sheltered accounts for investing in the stock market, but also in other capital markets like bonds. In the UK, we can put £20,000 a year into an ISA and never pay tax on that ever again. And with the SIPP, you're not going to pay capital gains tax or income tax either until you take the money out, in which case it's taxed as income. And the SIPP limits are up to 60k per year, so very generous. Another benefit is the very low cost of investing in stocks. If your platform fees are added to your fund fees, usually that will come to 0.2% or less, and if you've got $1 million invested, you'll pay almost no percentage fee if you're on a fixed fee platform, but you will still pay for the funds that you buy. So in that case, you could reduce the cost to something like 0.1% or even less. Also, with stocks, it's very easy to diversify. There are lots of off-the-shelf global equity funds which buy stocks from all over the world, so at the click of a button, you can buy a pre-diversified global portfolio with a very low fee. And something which is often understated is the importance of liquidity. If you want to sell those stocks, you can do that at the click of a button. It's very fast, it's very cheap, it's very easy to do so. So if you need the money, you can sell your stock investments very quickly and easily. And I think that's very important because life always has crisis, and there are times when you need money fast. But it's not all rosy in the stock market. There are some drawbacks. I think the primary drawback is the roller coaster of prices when you enter the stock market. And this is not for everybody. It's very scary, and there are crashes, which can last for very long periods of time, although they are unusual. So if you're of a nervous disposition, investing in stocks is quite a scary thing. It's a bit like riding a roller coaster. And that brings me to my second point, which is that you need confidence in order to invest. I spend a lot of time trying to control my own behaviour to be more willing to take risks in the equity market, and that's largely due to the experience of how well it's performed historically, and also statistical studies which I've seen which show those very good performance measures. However, it only works if you stick with it and just let it do its thing and don't fiddle. Look through the volatility and just stick with it. I think that accountability and that education is very important. But another problem with equity is that it doesn't seem real. It's just a few lines on a computer screen. Often, we don't get share certificates. There's no evidence that we actually own anything. You just see the number going up and sometimes going down. And for some people, I think that intangibility is a problem, and it makes them think that it's not going to perform well, or they don't really believe it's performing well when it does. Now let's turn to the pros of the property market. Now I've built a buy-to-let property portfolio, and for me, it provides me with a source of comfort. It really acts as an inflation-linked bond in my portfolio in the sense that it produces a steady stream of inflation-linked income, which then feeds my other income. So I think it sits quite well in a portfolio alongside stocks. Of course, it's not either or, property or stocks. I think the two actually have a really good synergy when they sit together in a portfolio. If you do have lots of buy-to-let property, which is generally quite safe, then I think it allows you to take more risk with your non-property investments of this bond-like behaviour. The second point about buy-to-let property is that it does just plod along, and it does diversify your equity investments, which tend to be much more volatile. So if stocks do crash, it's quite comforting to have that steady income from your buy-to-let, whether stocks crash or not. And it's often the case that when stocks do crash, buy-to-let doesn't fall. Another reason I like property is that it's tangible. You can actually visit the house. You can touch the bricks and mortar, and that's comforting psychologically. It's often not about economics when people invest. It's often about these things, about things which people find comforting, that really matters for investors, particularly if the stock market's going through a volatile period. It's reassuring to have that tangible, safe investment in the form of bricks and mortar. Another reason why people like property is that you can leverage up your investment. Now, of course, leverage is a double-edged sword. If prices go down and you're over-leveraged, then you have a leveraged loss. So if you buy at the top of the property market and then things go south, you could be left with negative equity. If you're a long-term investor, that doesn't matter. But if you're into this idea of flipping properties, then that can be a real problem. Now, it turns out that stocks are also leveraged, because if you look at the balance sheet of any stocks on any stock market, you'll see that they have a certain amount of debt, and that amplifies their returns as well. So there you've got indirect leverage, and in property investing, you can get levels of leverage that would just be eye-watering for the stock market. 20-to-1 leverage, which you'd hardly ever do in the stock market, which is already very volatile. A final benefit, which is another psychological benefit, I think, is that property is difficult to sell. It's expensive, it's a time-consuming process, and this encourages a long-term mindset, which I think is very positive, and it discourages trading, which is very easy to be sucked into if you're in the equity market. Now, let's turn to the drawbacks of the property market. I think the first point is that it's expensive to maintain a house. If you've got renters and they're causing damage to the property, and just normal wear and tear means you have to spend money to keep the property in good condition. If you don't, it would be difficult to rent the property again if your tenant moves out. And of course, you've got a responsibility to those tenants. You have to maintain the house. I think that's just a moral responsibility as a landlord. That turns into the second point, which is the amount of time taken to maintain the property and also to keep it rented. Of course, you can outsource that to a company, but that increases your cost and reduces your net income. Another problem is that it may not be possible to rent your property out for 12 months of the year. There will be void periods when nobody's living in the property. Maybe you can use that period for maintenance, but it's going to cost you because you won't receive any income when there's no tenant. This is less of a problem if you buy property in a region where there's big demand for rentals. Often university towns are good for this because the staff at the university, but also the students, need accommodation. Another problem with property is that it's very difficult to sell. It's illiquid, which means that it could take a long time to sell the property from the point in which you make the decision to do so to the point where the money actually is in your hands. Compare that with stocks, where you can literally sell the stock in 10 minutes, or even a fund, which might take a couple days, is the geographic concentration. Usually, you'll be buying the buy-to-let properties in the country where you live, and that means the price of the house will be linked to the economic situation in your country. It's not possible to diversify across the world as you can with stocks, so you do have this geographic concentration risk, which gives you the best return on investment. Now, let's turn to the historic return on investments in the stock market and in property. Now here, the difference between buying a property that you live in and renting out a property becomes really apparent, because if we focus on the capital gain for property in the UK in particular, it's been awful in real terms for the last 2 decades. In fact, if we look at house prices as I make this video, and this is a nationwide house price index adjusted for inflation, the current average price of a home is exactly where it was in 2004, 2 decades ago. So this matters if you buy a house and you live in it, because that's the gain that you could get. The difference between the buying price and the selling price adjusted for inflation. And that's because when you live in a house, it doesn't generate an income, it generates cost. It's got a negative cost of carry, as we call it in the investment world, whereas a buy-to-let property, an investment property, generates a fairly high income, a yield usually of around 5%, maybe even as high as 8%, and that offsets the cost for maintenance and also for the mortgage servicing cost if you've borrowed to buy the house. So actually, the total return, income plus capital gain, is very attractive for buy-to-let properties historically. So now we'll look at some evidence on returns from a paper called The Rate of Return on Everything from 1870 to 2015. It's a brilliant paper. I recommend that you have a look at it. But what they try to do is a like-for-like comparison between investment property and also the equity market. And they also look at other things like bonds and bills, which we won't look at in this video. What's really surprising is once you start to factor in things like rental income, so you look at the total return of these buy-to-let properties, equity and property are pretty evenly matched historically in terms of total return. So what you can see in this graph beside me are that the average rates of return over the entire period for which there's data, but also post 1950, and as you can see, the rate of return on equity and on property is comparable. In fact, over the entire period, housing beats equity. Post 1950, equity has a bit of an edge. If we dig into the actual numbers in this table, what you can see for the UK, for example, is that the equity market was better than the property market, both over the entire period and the period after 1980. And for the UK, the equity market beat the property market by between 2 and 3 percentage points. And what I've done is I've shared the higher return in yellow so that you can quickly scan down the column to see which one performed best. What's interesting is that post 1980, the equity market has beaten the property market in every country. Post 1950, it's more equal, and over the entire period, it's also more ambiguous, which is the best investment. Another consideration is risk-adjusted return. Remember that with the stock market, it's a roller coaster, it's scary, and the prices are fluctuating all the time. Plus, it's prone to crashes. I think that with the property market, one of its benefits is that you don't update the prices so often. A house might just sell every 10 years or 20 years, so it's much more difficult to observe values in. So, although there might be underlying volatility you don't see, but certainly if you look at the typical annual percentage price move, that's what volatility is, and compare that with the returns, so you end up with a plot with risks on the axis, with the riskiest investments on the far right and the safest investments on the far left. What you see is a clear separation between property in red, which has a low volatility, and stock markets on the right, which have high volatility. So if we look at the Sharpe ratio, which is the excess return above the risk-free rate divided by the volatility, houses look much better on that risk-adjusted return basis. Another way to think of this is how much return do you get for every sleepless night? And in the case of the property market, you get bigger returns for those sleepless nights. So I think this is one of the benefits of the property market. Now, I mentioned combining stocks and property and how the property market can diversify the stock market. Another thing which this paper does, which is great, it looks at decade-long correlations between the property market, the equity market, and inflation. And if we just start with equity and property together to see how correlated they are over time, what's interesting is that the correlation increased during both world wars. Those are the shaded regions you can see here. But then in the post-war rebuilding phase, when there was a lot of economic growth, that helped the stock market, and it also helped the property market. But notice in the post-war period, that correlation has fallen to very low levels. The result of that is that if you have property and you have stocks, they do diversify one another quite well in this post-war period. If we think about inflation, what we want in an investment is something which tracks inflation and ideally beats it. And what's interesting here is that we've seen a negative correlation recently build up between the equity market and inflation. So if inflation is high, the stock market falls. Whereas if we look at housing, we've got a fairly consistent positive correlation between inflation and house prices. So as an inflation hedge, property looks better on this measure. Now, that doesn't mean the real return is higher. We're just talking about co-movements here. Remember, the real return on equity generally has been higher than it has been for property since 1950. Another really interesting correlation they look at is country co-movement. Now, in the stock market, countries tend to be highly correlated. If the US falls, almost every other country will fall with it. That's not true for the property market. If the US property market falls, it doesn't mean the UK property market, or even the European property market, or the Australian property market would fall as well. Consequently, if you do buy property in two different countries, they'll diversify one another very well indeed. So, in conclusion, there's no doubt that the stock market is a scary market. It's much more volatile, it is a roller coaster, and it's not suitable for some people. If you're scared of making losses, even if it's just paper losses, then the stock market may not be suitable for you. The housing market, my preferred market, although it does suffer setbacks, they tend to be shorter lived and more shallow than those you see in the stock market, although it depends on which region you live in. Another point is the amount of effort needed to maintain a portfolio. In the case of stocks, there's almost no effort involved at all. Once you buy a global fund, say, you can leave it and forget about it. You can't do that with property. I can think of another measure which would be return on effort, which is the amount of effort required to generate a certain amount of return. And in the case of property, return on effort is quite low, whereas with the equity market, return on effort is actually pretty high. I think transaction costs also favour the equity market, and also there are lots of tax sheltered accounts which favour the stock market too, certainly in the UK, and that's also true of the US. In terms of diversification, what's interesting is that if you hold buy-to-let and equity markets together, they do diversify one another. And as I say, I think of property as a kind of inflation-linked bond, which means you can take more risks with the equity part of your portfolio. And then, finally, I think the psychological factors shouldn't be underestimated. People like having something tangible, something steady, something which doesn't feel risky, and that would favour property and buy-to-lets. So I don't think there's a clear-cut answer as to which is best. Personally, I favour property, but I know many people who prefer stocks. If you want to keep up to date with what's going on in the property market, please subscribe to our channel. I hope you've enjoyed this video, and as always, I'll see you on the next one.